Welcome to Share Talk. Today I have the pleasure of speaking with Alex McDonald, the Chief Executive Officer, and David Sefton, who is the Executive Chairman of Anglo African Oil and Gas. How are you doing today, gentlemen?
Very good, thanks, Steve. Very good.
Yeah, it's a good day so far.
Well, things are certainly looking up. You have just listed your company on the AIM stock exchange here in London. Could you give us a brief sort of introduction to your past histories, please?
Yeah. Hi, I'm David Sefton here, the Executive Chairman. I started out in life as a barrister before getting involved in the oil industry. I worked at a US law firm, Cleary Gottlieb, and then ran the Chief Legal Officer for the International M&A for Lukoil, and then I spent the last 10 years running a private equity business which invested in the oil services business. Alex?
Yes, I've got a long history in the oil and gas industry. Started my career upstream exploration, mainly in places in Middle East and Africa. I've worked for some of the majors, including Conoco and Chevron, and I have actually worked in the North Sea as well. My career for the last 25 plus years has been in corporate finance, mainly in the oil and gas sector. There is one other colleague of ours who's key to this, who's not with us today, Oleg Shkoda. Oleg is our operations director, and he has extensive experience in Africa, and particularly in the Congo, where we have found this asset. He has worked in the last 10 years with Schlumberger, Baker Hughes, and GE Energy.
So, obviously, you just touched out on Congo. Could you give us a brief description, obviously, of the asset that you've acquired there?
Yeah, and we bought a field which has been in production for about 10 years, and it's at the moment, although it's got very extensive topside facilities, it's only producing about 38 barrels a day. But we have an interesting plan here, which is to just do a workover of the existing wells as a first step. Won't cost very much money and will get us up to a few hundred barrels a day, 200 barrels a day, say, of production. And that's key, gets us to cash flow stability very early. So when we can then go drilling, we're not having to cover our working costs out of capital. And then we have a drilling program which will target both the existing producing layers and also a deeper layer where our neighbours are getting some really substantial amounts of production. So we're very quickly going to hit the ground running, and it really is what we kind of like about the asset, because it's an asset where you can see that with the expenditure of a small amount of money, you can make it worth more than we're paying for it on the way in, and get it to cash flow stability. But you've also got this exploration upside into a really potentially transformative layer deep down.
The company we're buying, which gives us a real advantage on a very fast work program, is that it's an operating company. It has all the permits, licenses, and permissions, so we don't have that long lead time to establish those bits of paper. So we've got a 2-well workover and on existing wells to bring them into production to increase production up to at least 250 barrels a day. Then we've got the first of the 2 new wells, which is a multi-horizon well. It will drill the upper horizon, which is already producing on one of our other wells. It'll then drill into the Mengo, which is highly prolific in Congo. And Oleg Shkoda, whom I mentioned earlier, has actually drilled 6 wells successfully in the Congo and brought them into production anywhere between 500 and 800 barrels a day. Further down from there, we've got the Djengo, and as David was saying, our neighbours are getting significant production anywhere between 4,700 and 5,500 barrels a day. So that well, that first well, is economically de-risked because we will have production from the 2 upper horizons. We expect to get production out of the Djengo, but until we put the drill bit in the ground and get into that horizon, we're not really quite sure what we're going to get. But we know what our neighbours are getting. That's what gives us great confidence with this.
Now, in relation to your acreage, I've done a bit of background work and I found a company called Burren Energy that has historically been taken over back in sort of 2007. With this area being such a prolific sort of region, how were you able to get this asset at such a good price?
Well, we structured the transaction in quite an interesting way because the current owner, who is basically a French private family, and they don't really have the team in place to develop the asset, all the capital to throw at this. So they weren't that interested in an outright sale because an outright sale it was difficult to structure a price on that, which would give them the upside, potential upside of getting to these layers. So we've just done a deal where they've rolled the asset in and they're taking shares in the company. They'll be one of the largest shareholders in this, sitting alongside some big institutional shareholders. They're taking a little bit of cash off the table. It's basically half shares, half cash. So I think it was our ability to just kind of structure a deal which would enable them to give themselves a floor to the monetization of the asset, but also participation in the upside going forward that was key to getting it all wrapped up.
Just want to touch on the sort of political area. Obviously, you've already highlighted that all the licenses and permits are in place already for the production side of the company. Could you just explain about the geopolitical risks in country and the fact that there are effectively two Congos?
Yes, okay, we've always described this as the nice Congo. This is not the DRC, this is the Republic of Congo. Just a few bullet points on this. One, it's had a very stable oil industry background going back to the 50s and 60s, and a lot of the majors have been there. Currently, ENI, SOCO, and New Age are operating in country, and ENI have got 5,000 expatriate families, which is increasing by about 1,500 this year, and that's all to support the development of their offshore field. We've done a lot of research on this, obviously, originally, and we're very satisfied that economically, financially, we have a very stable environment to work in. There are no restrictions on repatriating capital, and there's very good PSC regime, and we've probably got one of the better PSCs in Africa. I was there a couple of weeks ago, went with my colleague Oleg Shkoda, particularly to look at drilling and workover equipment, because we've got a very interesting timetable which starts immediately after the listing today.
In relations, obviously, to the short-term news flow, then you've got the work over on the drills and the forward drilling program.
Yeah.
Long-term for the company, are you going to be exploring other areas, looking at other territories, or is it a case of you wish to offer sort of a remuneration package to your shareholders by way of dividends?
Yeah, I mean, it's a very good question, actually, because one approach we took to this, coming from a PE background, is having sat on the investor side of a lot of things, is you look at small E&P companies, and classically, if they, as and when they develop some cash flow, their immediate response is to go and find a matching liability, preferably 10,000 acres of jungle somewhere they can go and explore. But joking aside, I think it's very important that when a company like this produces cash flow, it flows through to investors as dividends. So we said that while we might add on some contiguous acreage within the Congo, or a related asset within the Congo, it's going to stay as a hypothecated vehicle concentrating on production cash in this country, and the profits from that and producing oil and gas should be an inherently very profitable enterprise. The profits on that will be flowed through to investors. So we've committed not only not to go and find assets elsewhere, but also to pay at least 75% of net free cash flow through to investors as a dividend yield.
So just to highlight that then, where would you see your cut-off point for profitability? Because obviously with the price of the oil regime at the moment, where would the cut-off be in regards to price of barrels and then obviously the amount of production going forward?
Well, again, it's quite an interesting one. I mean, it obviously slightly depends on the oil price. So it is around about sort of 200 to 250 barrels a day. But we also have another variability in here. and again, this comes from a PE background, that monthly costs of G&A, etc., should always be covered by cash flow. This shouldn't come out of capital. So after a short grace period, all the senior management's salaries and compensation packages here vary according to production and to whether or not the company is cash flow stable. So it gives us an extra degree of flexibility that that people's compensation packages, etc., are all dependent upon increasing and maintaining production. And if production doesn't go up for whatever reason to get the company to cash flow stable, people's salaries go down, so we get to it the other way around.
Is there anything further that you would like to add there?
No, I think I think really it's what makes us hopefully slightly different from some of the E&P propositions out there is that classically the reason people buy small exploration and production companies is because you get very interesting, very significant upside if it all comes off, and we've got that here with the drilling down into the Djengo sands. But what we've got, which is different, I think, is that we don't have the risk of total loss if that fails. If it takes us longer to bring the Djengo sands into production, or there are difficulties there, you've still got the existing production and the existing producing layers to be developed, and we should, if we execute on that well, get this company worth considerably more than we're paying for it, just on the basis of the existing producing and proven layers. Secondly, is that we've got an approach to cost which I think is very different from other people in the industry. And third is a focus on yield, not asset aggregation.
Right. Thank you very, very much for your time today, David and Alex. It's been a pleasure speaking to you, and look forward to following your story going forwards.
Thanks, Stephen. Thank you very much indeed.
Thank you.